Hi, and welcome to the week ahead. I'm Tony Nash. Today, we're joined by Jim Iorio. Jim is at DJM Institutional, and he heads the Futures Edge podcast, or is on the Futures Edge podcast, right?
Yep,
Also
that's
with
correct.
Albert Marco and Tracy Schuchart with Hightower Resources Advisors. We've got a couple of key themes. Obviously, it's the week before the Fed, and we've had a really good week in markets. So, one of our key themes is, are markets too good for the Fed? Second is, I think Tracy is going to talk about crack spreads and Freeport and what's happening there. And then we're going to look at the risk with Ukraine's new hardware. There's been a lot of talk about tanks going to Ukraine this week. So we're going to talk about some geopolitical risk with Albert. So Jim, first, thanks again for joining us. And watching some of your comments through the week with markets breaking through some of the key levels that you were looking at, the Fed's direction is obviously a big factor in markets, and there's a lot of conjecture around CPI, layoffs, rates going lower, or pause, or pivot, or whatever you want to call it. And people saying the Fed may do 25 and then pause. What's your view on that? I mean, you've been obviously speaking about this several times this week. So I'm curious, what's your view after seeing a whole week? Where do you think we go from here?
Well, I've been somewhat more of a bull, I think, than most over the last few months. And at first, I think, and I'm not trying to take a victory lap or anything, it's just a fact. And my reasoning was that every one of us knows that these Fed rate hikes have a huge lag period before we feel the efficacy. The Fed knows that too. As stupid as the Fed is, this is something that's so fundamental, but I think they genuinely do know that. So now we're starting to see the things happen. We saw a pretty good PCE report today. CPI has been trending lower too. The only things in CPI that are stubbornly high consistently is food and energy, which are the two things that are least rate sensitive. The yield curve is still wildly inverted, signaling to them that they still are, the financially tight market. I believe that the Fed is getting close to having some sort of gentler language. Now, whether they go 25 basis points this time and then 25 basis points again, that's fine to me. Now, the one thing I do have a problem with is that the Fed funds futures curve says 50 basis points over the next two meetings, and then toward the end of 23, there's going to be an ease. But they say it's only going to be a quarter to a half a point ease. And that, I say, no way. If they're ever going to actually pivot and start easing, it's only going to be as if something is burning and something is falling down, and then it's not going to be a quarter point ease. That being said, I still like risk assets, and I have, because I think we are nearing the end of the Fed tightening cycle. I believed, I've been doing my podcast for the last hour. I wanted the market to settle above 40.70. It certainly did, right? I mean, we went into the close pretty strong, I thought. And I think that green lights the next move higher. I particularly like the metals market. And I'll shut up in 1 second, I swear to God. I particularly like the metals market because I think that, I don't mean to talk for so long. I thought copper was being held down by, China news, by the Fed, by the strength of the dollar, and all those things have seemed disappeared. And I've made good money on that so far, and I plan on keeping those longs.
So it's a good question about metals. How far, what are you looking at? You said China, and you said, China reopening, other things. What are you looking at in metals? Are you looking at industrial metals, copper, and so on? Or are you looking at precious metals, or kind of all of the above?
Copper is number one, and that's my biggest position. Silver, and then go down from base industrial all the way to just gold being precious. And the gold thesis for me is different than the copper one, in that I believed at the time when I started buying more gold that Bitcoin and Ethereum and the crypto market and all that dollar safety hedge or whatever the hell it is, if that was disappearing, then money would go back into gold. Well, that didn't disappear. Bitcoin is butting up against new cycle highs now, but gold is still doing well. So in that, I was kind of wrong on the thesis. The thesis was also the dollar weakening, which happened as well. Once the pound and the euro started really bouncing off those October lows, I thought, okay, the green light is on for all these metals. So I've done okay in gold, even though my thesis about crypto was wrong.
Okay, but was your thesis wrong? Do you see crypto and gold as substitutional somewhat at the margin still?
I don't know. I was going to ask you that same question. I always did. And I thought that, the $3 trillion crypto market was sucking away some of the gold. And I thought that was a big deal. But then it doesn't seem to be now. So I guess I can't answer that. I'm confused, I guess.
Yeah, I'm curious, what do you think about that, Tracy, in terms of crypto and gold? Do you think there's a trade-off there?
This is not really my crypto market is not really my market at all.
It's the internet. Say whatever you want.
But I mean, Albert knows way more about this than I do, to be honest, because I've never traded crypto and he's traded a lot in the past. So I'm going to defer this to Albert.
Awesome. Okay. Albert.
Yeah, before I do think that there was a correlation between how much money was flying into crypto versus taken away from gold. I think there was no doubt that gold suffered because of that. I don't think that is the case right now, simply because there's been too many blowups in the crypto world at the moment. Now, I don't really know how liquid it really is. I mean, there's certainly no retail left in the crypto market, so it looks like it's all institutional. So I don't know. Like, I really. You can't really make a fundamental call on crypto at the moment.
Could you ever make a fundamental call on crypto?
Well, you could at some point, because institutional money was flying in there because their clients were forcing them to get into the space. So you could make a little bit of a fundamental case for crypto. But I mean, as all these Ponzi schemes blew up, like FTX and everything, that's just gone completely out the window at the moment.
Sure, Tony, I can make a slight fundamental argument of it when they were adding an additional $7 trillion, throwing it into the money supply and really, being poor stewards of the dollar. That was somewhat of a fundamental argument for crypto, I guess.
Right? Yeah. So, Jim, okay, so are markets too good for the Fed? As we're going into next week, are these levels too good for the Fed? Is Powell going to come out and really, say, look, this is irrational or whatever, and it's too much? And is he going to pour out, say, 50 basis points and disappoint, a lot of people?
Just to punish me, a rug pull? I mean, I think he's capable of that. He certainly did it at the Jackson Hole meeting a while back. So you've identified, I think, the major risk, and it'll probably go into that somewhat hedged. And again, hedging is probably going to be expensive going into it because people realize that that's where the risk is. So on balance, I will say, no, I don't believe he is. I think he believes that going too far this way, and again, I think he thinks going not far enough in this direction is the worst possible thing. But I also think he's starting to realize going too far and what that looks like. He sits around and talks about creating slack in the job market, and to him, it's just an equation on a whiteboard, where the reality of it is he's talking about people losing their jobs. I think he balances a lot of realities. I think he's incompetent. His entire tenure has been mostly incompetence, but I think he's done a pretty good job trying to clean up the mess that he made over the last year and a half. And I don't think he's going to do something stupid like that. But yes, to your point, it is a risk.
I actually disagree with Jim on this.
Oh, nice, go!
I think it's going to really matter about what the market does. If we start flying into the 4200s before Tuesday on the SPX and whatnot, I think that Powell will come out. I don't know if he'll do 50. Right, I don't think he'll do 50, but he might come out with a 25 basis point rate hike and then start talking extremely hawkish and dismiss all the rate cuts that everybody's been talking about, which would be essentially the same thing as doing 50 to the market. If the market says that if the market hears that we're not getting rate cuts till 2024, I don't see that as positive whatsoever.
I certainly hope you're right in the near term too, because I'm short some of those 4,200 calls, like too many. Like that's the position I keep checking in my bull positions. Like, oh shit, they're getting too expensive. So I actually like what you're saying a little bit in the short term.
Yeah, I have a problem because like there's falling liquidity right now and tightness at the same time. It's like I look at the market and I'm like, well, money is starting to fly out into Asia, which we talked about, Tony, repetitively for months now, right? Where are we going to get that $5 trillion incremental money coming into the market to keep this thing afloat? For me, it's like I don't see the math adding up to 4,300 on the S&P and anytime soon. And on top of that, if you calculate rate hikes and everything, you're looking at the market, 4150 or 4,200 is more expensive than 4,800 was. It's technically an even higher valuation. So for these things, I'm just like, I think we're probably going to retrace the 3,850 on some kind of ridiculous Powell talk. And on top of that, Brainard is talking about leaving. She's not leaving if if Powell's talking about being dovish. It's just she wouldn't be doing that, in my opinion.
Yeah,
Can I ask a question? You know, I was just thinking and that's for both of you. I mean, considering that the Fed has hiked so quickly, do we even think, and the data has remained pretty good considering, right? So do we think that the data, or do we think that the rate hikes had actually even been able to filter down into the economy yet? And so
I don't, Tracy. I think that that's the point. I think when you look, just take the real estate market. How in the world is it not going to be a major hurdle for the real estate market to take mortgage rates from 2.8 to 7%? I think that it's silly to think that if they just left things the way it is, I believe that we would certainly go in recession at some point in time with money being restrictive as it is, compared to, I've argued for 30 years that rates had to be inorganically low to make up for the fact that, you know, we have all these crappy regulations and punitive taxes on companies. They need low rates to function. I think rates are at a point now where eventually they would drag on us too much. Albert, do you agree with that?
I do. But the flip side of that is, like, if Powell doesn't stay the course, you know, Yellen's using the TGA, in my opinion, from what I heard, to offset quantitative tightening. This could set off another round of inflation if China comes on too fast, or even Europe starts to gear up a little bit and reset their manufacturing sectors with stimulus. The fear I have is a second half inflationary run again. And then we're going to be talking no more pauses, but another round of 50, 75 basis point rate hikes.
second
And
half
what fuels that? Wage?
Q2. I don't think it's a second half inflation run. I think it's Q2. I think it happens a little bit sooner than that.
Yeah, it could. I mean, you could have any kind of geopolitical event like Russia reinvading Ukraine with some gusto this time. And
Okay, guys, here's my question though. Like, we're talking all this potential dovishness, but all we've seen is the rate of inflation slow. We haven't seen prices come down. Okay. So why would he go to zero, or why would he just do 25? I'm not seeing it. When you look at the job market, sure, you've lost 70,000 tech jobs, but they hired 2 million since 2020 or something like that, right?
Mhm.
So it's nothing. It's drop in the bucket. So what?
Chipotle's hiring 15,000, so those people can get a job.
Right.
Burritos, baby. Yeah.
Exactly. So what is it that would tell us that he's going to go 25 or pivot or whatever? I'm just not seeing that thing, because the job market's still really strong.
So here's what I would say to that is that the job market's going to be strong and tight. And it's a weird kind of anomaly that happened with 3 million boomers leaving the job market prematurely over the last 3 years. To your point about why would he not stay the course if prices aren't coming down? Because remember, ultimately, at the end of the day, the inflation was intentional, and it was done because of this wild indebtedness all over the board. But I always focus on the 5 states that could not possibly have paid their bills under any possible scenario. And that's why for 10 years, they kept telling us that they needed inflation. So I think in Powell's mind, he tells us 2%. I think he'd be perfectly happy with 3.5%.
And they'll get 3.5 because they're starting to change the way CPI is weighted starting in 2023.
Just
So
like
they'll
when
get
Nixon changed the
Exactly.
definition of full employment
Well,
back in the
look at that,
70s.
they've done
right?
that. The BLS have done that in the past. They changed the way unemployment's calculated. Now they're changing the way the CPI is calculated.
Change the way
And
the inflation's calculated.
Yeah,
Since
it-
the 19th
perception-
Amendment.
Yeah, perception is reality in the markets. I mean, we can sit there and bitch about, fake data from China and fake data from Europe and the US, but perception is reality in the markets.
Yep. So we're going to change the rules to win.
Well, yeah, of course.
And the CPI calculation changes this month, right?
Yeah, January 2023.
Fantastic. Okay, so you guys are in the 25 basis point camp for next week, right?
25 and
Yes.
very
25 and very hawkish. Okay.
I
Yeah,
like
yes.
what Albert's saying. I say 25 and mildly hawkish.
All right. We'll see. I think it might be a little harder than that. So we'll see. That's good though. I appreciate that. Okay. Tracy, I want to talk a little bit about refineries and crack spreads. You sent out a tweet on Monday about diesel prices. Can you help us help us understand what's happening at refineries and what's happening with diesel and gasoline and other refined products prices?
Well, this is actually the perfect segue because, I tweeted out a chart of ULSD, which is diesel basically.
Yeah.
And so, we're seeing those refinery margins explode again. And most people say, well, that's anticipation of the diesel embargo in Russia. And, refineries across the world that are not part of Russia are seeing these increases. But that's not just happening in the diesel market, that's also happening in gasoline cracks. And so basically the long and short, higher refining margins mean higher prices for consumers, right? So Tuesday, we just hit a 3-month high of $42. And when oil was at its highest price, those crack spreads were at $60. So this should start ringing alarm bells a little bit about inflation. This is why it kind of correlates to what we were just talking about. And so CBs, even though they don't count energy in the CPI, as part of inflation, they should be keeping an eye on these indicators because it kind of indicates that we're going to see higher gasoline, diesel costs, jet fuel, etc. And that could be, that could add to inflationary pressures across the board, not only for just the consumer, you and I, but for companies that are heavily dependent on these products.
And when there's inflation in energy, there's inflation in everything, right?
Everywhere, right?
Secondary, tertiary impacts.
Exactly.
Yeah,
And then-
Tracy, one of my oil friends was telling me that normally January, February, they're running at minimum rates, trying not to lose money. But this has been like absolutely insane, where they're just making money hand over fist right now because the demand is so high.
So why
Tracy,
is
I have-
this year different?
I have a quick question for Tracy, by the way. Is that okay?
Yep.
So Tracy, just last week, I don't know if it was Chevron or ConocoPhillips, where they announced they're raising the dividend or whatever, or paying bonuses and not investing in it. Was that an indication that they still feel that the government is not smiling upon fossil fuel companies expanding their operations?
Oh, 100%, right? So we've seen for over a year now, we've seen elevated energy prices in that $70 to $80 range, right? Negating the spike that we saw from the Ukraine invasion. But so after a year of pretty much stable, higher energy prices, we are still not seeing anybody want to invest in this sector, right? They still want to cater to the investor. They still want to pay down debts. They still want to do higher dividends. They still want to engage in stock buybacks, right? All to placate the investor. And so that is very telling that after a year, they're still not willing to reinvest into, into CapEx, particularly in shale. So
Why would you? It's nothing but downside to invest, right?
No doubt. Yeah.
Absolutely.
This is absolutely, it's maddening when you think about it. It just, everything seems like it's such a self-inflicted wound. And this is the kind of thing that keeps me up at night. It seems like a government that's working against us. And I'm not trying to be that guy who, I'm not political. You see policies and they're asinine.
Yeah. Well,
who wants to invest when they say we want to phase you out in
we want to kill you, right? Yeah, right.
Yeah, well, this is the problem when politics gets mixed up in economic policy. It starts muddying things up, and mistakes become exponential at this point.
Yes, but politics is always mixed up in economic policy everywhere. I mean, that's just you know that. I'm not telling you anything you don't know, but it's always there. And so I just, when I hear you talk about refineries, and it's been how many decades since we built refineries in the U.S., Tracy? The 70s was the last time we built refineries?
The 70s was the last major. We've had a lot of brown projects, which means we've added refinery capacity to already existing refineries, but we haven't had any new, green projects, which means, building new refineries. And, we are having, we were talking about, I think last week or the week before, the expansion that we're having in Texas. But the problem is that the amount of refining that is coming offline is more than the refining capacity that is coming online.
Right. So what's our capacity utilization right now in refineries?
Well, we're down right now because we're in the middle of maintenance, and we also had Elliott storm, which some refineries, for instance, Baytown, is just coming back up this week from the storm in December. So utilization rates right now are about 89.5%. But you have to realize that's we've been well over 90%.
Yeah, 94 or something like that, right?
Yeah, and we have aging refineries. And so what does that mean? Those refineries are more prone to breakdown because we're running them at like ridiculous max capacity.
Yeah.
And
Which
so,
they were designed for, right?
Exactly.
Okay. So since you mentioned Texas, let's look at this tweet that you put out a couple days ago saying that Freeport gets approval. So US LNG, the Freeport terminal, has been approved and reopened. So can you talk us through what that means for European nat gas and what that means for US nat gas prices?
Well, for U.S. nat gas prices, that is positive, and I know that all nat gas prices have tumbled, 35 to 45%, or regardless, we're back into that 2 area that is pretty much where we've been for several years. But that is it is a good thing. I think the market, I think, spiked 15% or 15 cents, sorry, on that move, and they kind of retraced it. I think the market is a very, that Freeport is an export place. So what that means is that, if Freeport being closed basically landlocks US nat gas, which is obviously a negative because we have a lot of it. And so, but I think that the markets in general is a little bit skeptical, but as soon as we actually start seeing export capacity increase from that facility, then I think that the markets will be more enthusiastic about the success of that, because it's really been since August since that facility shut down.
Right. So we'll see. So you're saying we should see US gas prices rise as we have more export volume from Freeport.
Absolutely. And, even this week, Sempra Energy announced that their new Port Arthur facility has already been booked. And that facility isn't even all the way built yet. And that's another export facility. So there's a lot coming online and a lot being built out that we will be able to see. I think that just market participants have become a little bit placated because they look at, European stocks, and European stocks, of course, are, they're still full. They've had a mild winter, but everybody kind of forgets that last year, 50% of their storage capacity came from cheap Russian pipeline. And that's not going to happen this year.
Yep. So all of those new roads that are being built in Texas, it may have been started with other money, but it's going to be finished with European money, right? So I just want to take this moment to thank our European friends for finishing. That's right.
About time they give back.
What's that?
About time they give back.
That's right.
Damn straight. Finally, their currency has come back a little bit, so now they can actually buy stuff here. Yeah.
Perfect. Okay, very good, Tracy. Anything else on nat gas? Are you still keeping an eye on fertilizer for kind of late spring time period?
Yes, absolutely. I think that'll still come into play. I mean, nat gas prices are extremely low right now, which is great news for fertilizer prices. That'll give farmers a break. I mean, this is all good news in that respect, but I still think we need to keep an eye on this going forward, and keep an eye on nat gas prices, because obviously that's going to affect fertilizer prices and farming in general.
Jim.
Tracy, you talked about diesel before, and I don't trade diesel. So is the spread between diesel and regular WTI still blown out, and what could possibly get diesel back in line?
Well, I think that, I mean, there's been a shortage for a very long time. That spread's come in a lot, comparatively speaking, but now it's starting to blow out again because, again, you have the EU embargo of diesel, and they got literally like 95% of their diesel came from Russia, another dependent project. And I'm sure Russian diesel will go somewhere else. So it's not more about that, but it's more about it really boils down to refining capacity as well, because even in the United States, we can't refine. If Europe wants to buy from us, we can't even refine enough. I mean, we're sending what we have over there as well as our domestic needs. So really, diesel to me comes down to refining capacity
And
altogether.
that's an unfixable problem, right?
Until Russia's solved, right?
Yeah,
Right.
Tracy, what about the Jones Act waivers for sending diesel up to the East Coast cheaper?
Well,
Shouldn't that-
yes, they could do that, but they haven't done that. They've done that in the they've done that in the past for Puerto Rico,
Mhm.
when after the hurricane and all of that, but they still haven't given waivers. And even when prices were extremely high in the United States, right? When we were at the height back in June, July, when gas prices were highest, diesel prices were highest, they still wouldn't give Jones Act waivers. And you have to understand that the Jones Act came into play into 1920 when we had a fleet of over 1,000 vessels, and we now have under 100 vessels that can transport that. So, the government could do it. They've chosen not to. Why? I'm not sure. But
We could come up with some guesses. They're either stupid or they're nefarious. I believe it's at some point in time you're going to have to say some of it's nefarious, where they keep making the wrong decision at every turn. And I apologize for that.
No, don't apologize. Look, if it's making it more expensive for people on the East Coast to get diesel, it's not good.
Mhm.
So, okay, great. Speaking of Russia, Albert, we saw a lot of news over the last week about tanks going to Ukraine. And there's a tweet from Max Abrams, who's a great geopolitical professor, talking about Russia says that tanks from the West count as, quote, direct involvement in the war. So I wanted to get Jim said what would solve the diesel problem. Obviously, Russia coming back into the market would solve the diesel problem. Now, with a lot of Western countries sending tanks to Ukraine, that doesn't sound like we're coming closer to a solution on that. So first of all, why are they sending them if they don't have the people to operate them? Second, tanks are to take land, right? So, what do you think is being planned? And third, how risky is it? Do you think it really implicates these kind of donor countries as direct participants in the war?
I don't really buy into the whole direct participants of the war. The rhetoric coming out of Russia is a little bit, bombastic in that respect. Referring to those tanks, there's only going to be about 100 of them, right? They're not going to be able to push out the Russians with those tanks. On top of that, they're going to be about 6 months out until they're actually even delivered. And then you still have to train these guys, and they need supplies, and the Ukrainians don't really have all that. So the best guess that I have is that they're forcing Russia to come into a ceasefire in about 6 to 8 months time, which gives them a window now to try to take Donbas and have some kind of win before these tanks get delivered. I mean, listen, they're no joke. The Leopard tanks and the Abrams are better than what the Russians have, but in terms of the Ukrainians using them to push Russians out of all Ukrainian territories, that's just not happening.
Right. So are these just old tanks, or is it quality kit that they're getting?
Well, I think they're getting like the second tier tanks of what the West has, but that's still better than what the Russians have or even willing to use, for Ukraine. So, like I said, this is more of a measure to force a ceasefire later on in the year.
Okay. Do you think, yeah, Jim?
So, Albert, so a couple days ago, when this escalation started and Germany announced, we announced, I immediately put on my screens, looked at oil, wheat, even the defense sector ETF, and nothing really budged. Do you think the market was looking at it like it wasn't a big deal, or do you think the market was looking at it as somewhat balanced, perhaps a quicker end of the war and not an escalation, or perhaps an escalation and the two things counterbalance?
Oh man, that's a good one, Jim. I honestly think that the market's probably in a wait and see position at the moment.
So just numb to the shit, kind of, right? Just numb.
Yeah, just you got to wait and see what Moscow's going to do. I certainly think they're going to use wheat and grains and other grains as asymmetrical responses to the West to push inflation out over there, make it hurt. That's the only thing they have. They don't really have anything else to go after. I mean, the oil that they're selling to India and China is enough to sustain their pocketbooks for a little while until this gets sorted out. But until there's some sort of major upheaval in Ukraine, I don't think the defense stocks will take off or wheat yet, but they will. I think they will. And
the defense stocks haven't moved for a while. So do you think, so if it is wheat and other ag stuff that is going to be their lever, that probably means the Turks would get more involved in the discussion because they're the ones who arbitrated the discussion earlier. Is that right?
Well, they're trying to get into the discussion. I actually have really good connections with the Turks, and their main thing is to distract the West and the Russians into Ukraine while they push their trade deals out into Africa at the moment. You know, the Turks have a great drone, the TB2, which they sell to pretty much everybody. So that's as far as they'll actually get into the war, besides making, media comments.
Right. Okay. And so what risk do you think there is on wheat? Do you think we see more wheat risks, say in Q2, Q3 of this year?
I absolutely do. The Ukrainians they're planting a lot less. I think 40% less is what they're reporting. It's probably even more than that, right? And on top of that, if the Russians decide to blow up a port or blow up a few ships that are trying to get out with wheat, then all of a sudden wheat, takes off back to the 900 or $1,000 mark again. So I definitely see that happening Q2, Q3.
Okay, that could be exciting. All right, guys, let's close it up. We're in that quiet period for the Fed. We have that Fed discussion next week. So what are you keeping an eye on next week, aside from the Fed, of course, but what are you keeping an eye on in markets? Tracy, you want to get us started?
Well, I know that most people are looking forward to OPEC is next week, beginning of February. My personal stance on that is that I think they will keep everything as is, right? They made that 2 million cut, even though it's technically not 2 million because they were under quota anyway. They said they were going to carry that through 2023 unless something came up that they really needed to address. And I just don't see anything coming, I don't see any reason they would need to change this policy stance right now. We have Russian barrels still on the market. We have China still kind of an unknown because they haven't really opened up yet. So that's what I'm looking forward to, or at least that's what my feeling is about the data.
Great. Okay. Albert, what are you looking at next week?
Sorry.
Well, obviously the Fed. I think
Yeah,
25 basis is in order with a hawkish tone, but honestly, I want to see how the dollar reacts to all this, and the VIX. The VIX at 17. You start looking at some good old, put options and call options. With the 17 VIX is fantastic. So, but yeah, basically what the dollar is going to do. I really want to see if the dollar breaks into the 90s with some kind of bull market talk.
Excellent. Okay, and Jim, wrap us up. What are you looking at?
The unemployment numbers on Friday, big deal. The last shoe to drop is going to be the slack in the labor market that they want. Albert mentioned that level in the dollar. I'll call it like 101 to 100. As soon as it goes below that, as soon as we get a 9 handle on the dollar, I think it green lights a lot of risk assets. But the thing I'm mostly focused on is unemployment. And then the week after that, my trip to South Florida, because every time I leave these damn markets, something crazy happens. So you guys can count on that. I'll tell you, when I'm on my flight, something weird's going to happen. Yeah.
Okay.
Perfect.
And when is that? When is it? When is the flight?
I don't know. My wife makes the arrangements. I think it's the next like a week from next Thursday. I think we're going on vacation.
Keep an eye on that. All right. Jim, thanks.
Writing it down.
Yeah, thanks so much for joining us, Jim. Guys, this has been great. Thanks very much, everyone. Have a great weekend.
Thanks, Jim.
Thank you, guys. Yeah, let's see you guys.